Hi, this is Brad Olson with Oak Tree Financial Services. I'd like to welcome everyone that is joining us on our webinar to discuss Roth conversions. One of the areas that we want to make sure that we're doing is communicating with our clients on current ideas that really are important at certain times. And we feel that right now, a Roth conversion idea is something that everyone should at least be looking at as a possibility that will work into their portfolio. So what I'd like to do again is say thanks for attending. I know we have several people that are online listening, and I will get started, and we'll keep this to about a half an hour as our total time that we're looking at for this. So let's get started here. And first of all, I want to take a look and say, why should I consider a Roth? There's several reasons when we're looking at Roth conversions of why we should look at a Roth conversion. Basically, what we're doing is say, taking your IRA and moving it into a Roth IRA. The difference is an IRA is going to be taxed when you take it out, a regular IRA. A Roth IRA will not be taxed because you've already paid the taxes. So let's take a look at how this works. First of all, some of the basics. As you're looking at a Roth IRA, there's several things that we want to make sure that we understand. First, Roth IRA contributions are not tax deductible. There's no upfront tax break. The difference when you put money into a regular IRA, you may get the deduction for that off of your taxes. With a Roth, you don't get that. So you're paying taxes on the money before it goes into the Roth. You can withdraw your contributions, but on earnings at any time with no tax penalty. That's because you make contributions with after-tax dollars, so you've already paid the taxes on that money. So basically, when you're looking at making your Roth withdrawals, you are able to get the money that you put in. Now, withdrawals of earnings are tax-free and penalty-free if you're age 59 and a half or older, and it's been at least 5 years since you made your first contribution to your Roth account. That's what's called the 5-year rule. So there are some areas where if you were to take out the money that you've earned in your Roth early, before the 5 years or before 59 and a half, basically there can be some withdrawals penalties for doing that. So you need to be cautious when you're looking at taking that money out early. Now, the good news is when I make my initial Roth contribution, that does start that 5-year window for those contributions. So once I set up a Roth, and I did it 10 years ago and put in $1, that 5-year window for that is there. Now, there is a difference when we're talking about conversions, and I'll cover that in just a second. Roth IRA contribution and income limits for new contributions into your Roth. Now, we're not talking about conversions. We're talking about putting money into the Roth. 2022, your tax years, you can contribute a total of up to $6,000 to your IRA accounts, both Roth and a regular IRA. There's an extra $1,000 catch-up contribution if you're age 50 or older. So just keep that in mind, that there is a catch-up contribution from that standpoint. To contribute to a Roth, you must have earned income that equals or exceeds your contribution. Same thing with a regular IRA. You have to have earned income. I can't take it out of my savings, move it into my, if I didn't have any earned income, and move it into a Roth or a regular IRA and make that contribution. There are also income limits, meaning your maximum Roth IRA contribution could be reduced to zero, depending on your modified gross income. To contribute a full amount in 2022, your modified adjusted gross income had to be less than $129,000 if single, or $204,000 if married and filing jointly. So there is also a table that I have available that we can cover with that to talk about what those limits are, because there are some phase out limits that you have on what you can put in IRAs. So if you're earning over a certain amount, you could basically not be able to put money and have it be into the IRA or to a Roth IRA. So it is something that we do have to take a look at. And it does make a difference if you currently have a plan at work, or if you don't have a plan at work, it can vary. Now, just a side note, and we'll talk about this later, with a regular IRA, you can put non-deductible amounts in, and there is no limit on that. And there's a strategy that we may use for that later on. So I just mentioned that. The Roth IRA 5-year rule, the 5-year rule for the Roth IRA IRA distribution stipulates that 5 years must have passed since the tax year of your first Roth IRA contribution before you can withdraw the earnings in the account tax-free. Keep in mind that the 5-year clock begins ticking on January 1st of the year you make your contribution. So that starts that 5-year window ticking. That's why I tell people, if you're going to make contributions over the years into your Roth, then if you do it and you say, I can make a $100 contribution today, that does start that 5-year window ticking to make it so it's going to be easier to get at your earnings. Remember, you can always get at your money you put in. Now, with a conversion is a little different. When you do a Roth conversion, when I move from a regular IRA into a Roth and pay my taxes on my IRA, but move it into the Roth, if I do that conversion, each conversion has its own 5-year period. For instance, if you converted your traditional IRA to a Roth in 2018, that 5-year period for those converted assets begin January 1st of 2018. If you later converted again and did one in 2019, you have another 5-year conversion table for that. So it just means it's different than your contributions. They start from the first contribution, that starts the 5-year. But when you do a conversion, if I move $100,000 out of my regular IRA into my Roth and pay the taxes on that and put it into my Roth, that window starts with that conversion. If I do the same thing the next year or do something less the next year, I still have that 5-year window. So do remember that. Sometimes this can be a little confusing. And as I've dealt with people over the years, they get kind of confused between the contribution 5-year rule and the conversion 5-year rule. So that is something to keep in mind as we go forward. What is the purpose of a Roth IRA conversion? The main reason people convert traditional IRAs or other retirement accounts into Roth is so they can enjoy tax-free income later on. One of the areas that we like to do from a planning side is really mix IRA contributions if it makes sense tax-wise. We look at using both Roth and regular. The reason is that way we have money we can access that will not have the tax consequences that your regular IRA has. If you have everything in the regular IRA that you had deductions when you put it in, or you didn't pay taxes on it, if it was a 401k type of contribution and it was rolled into an IRA, what happens is this allows you to have some income with this conversion to a Roth to be able to get at it. They also have flexibility to not make withdrawals if they don't need the money. That's because Roth IRAs, unlike traditional ones, aren't subject to the required minimum distribution during the owner's lifetime. So that is an important element there that we must highlight, is there is a difference. You do not have to take money out of your Roth during your lifetime. So when you get that money with the Roth, you don't have to take it when you reach 72, take your required minimum distribution the way you do on a regular IRA. And again, we can go into more detail about that in individualized type of consultations. When you're looking at what is a Roth IRA conversion, again, a Roth IRA conversion involves transferring retirement funds from a traditional IRA or 401k into a Roth account. The account holder must pay your taxes and convert it over, but the withdrawal from the Roth account can be tax-free in the future. So by moving the money from the regular IRA into a Roth, I've moved money over now. As it grows, it'll grow on a tax-free basis. This strategy can make sense if the person believes they will be in a higher tax bracket in the future, and they'll save money by paying taxes now rather than later. So it really is a math calculation that we look at with this to determine where you are from a tax standpoint. Roth conversions completed after December 31st of 2017 cannot be turned back into traditional IRAs. We previously had the ability, you could reverse your conversion if you decided it was more advantageous for you to do it after you kind of did some tax planning. You could do that after December 31st of 2017. You cannot reverse that conversion. So just a side note there. How a Roth IRA conversion works, some more. Conversion must be accomplished, can be accomplished in several ways. It can be a direct rollover from a defined contribution plan. If you're leaving your job or you left an account behind with a former employer, the plan administrators can send a check to your new account or give you a check and made out to the new account accordingly. A trustee to trustee transfer, in which the assets are directly transferred from the current trustee, the current custodian, where your traditional IRA is held, and where your new Roth will be held. So basically, you're rolling the Roth into you're rolling your IRA that you currently have with that custodian into a Roth custodian. We can do that. A 60-day rollover in which you take the money is paid to you, and then you have 60 days to put it back in the Roth. So for example, I could take advantage of the 60-day rollover if I wanted to float that money. I do tell people with this strategy, you have to be cautious, because if you go past that 60 days, you will have tax consequences a lot more than what you may have planned from that standpoint. So just be cautious, because I have had people, especially with regular IRAs, that have taken the money out, plan on putting it back within the 60 days, something comes up and they don't get it back in. There can be some rather severe penalties that we just have to make sure that we're addressing. The first two methods are generally the safest and most practical. Again, I mentioned about being cautious with the 60 days, because you could face a 10% tax penalty if it's before 59 and a half. In addition, 60-day rollovers, unlike other two methods, can be subject to a 10% withholding. The government may say, we want to make sure we have our taxes. So if you're rolling over a $10,000 IRA, you would only receive $9,000 because they would withhold the taxes. So just be cautious with the 60-day rollover. Again, I want to make you aware of it, but I think it's something that we use on a very select basis if we're going to do that. Some solid planning ideas when you're talking about a Roth. One of the areas that the reason I'm doing this now is, with the markets being down, it's a decent time to convert, because what you're doing is you're converting an asset that you have, and I'll show an example of this, that the value's down. If I bought a stock at 100, now it's at 50. If I convert that stock at 50, I pay taxes on it. I put it in my Roth, I let it come back, and now I don't have any taxes on whatever gain when hopefully the stock comes back. And we feel with market corrections, market adjustments, if we own good things, we feel confident over time, good companies will seek a certain value. You don't have to worry about your RMDs, another planning tool. You then have money to access tax-free money, not by having it all in your regular IRA, by having it in your Roth. You have a place now where if I want to take out $20,000, I can take that $20,000 out of my Roth and not have to pay taxes on it. Again, remember the 5-year rule. We have to address that. There are some things we have to look at, but in general, this is the reason why you do this. Now, I mentioned a couple of planning ideas here. Affordable Care Act. I have actually had people that have retired, are not tapping into their nest egg yet by saying, okay, send me an income out of my IRA. So we have to pay taxes on that. So what they do is they say, I'm not going to take money out of my IRA. I'm not generating any other earned income now because I'm retired. So actually, if I'm below age 65 and not on Medicare, I need health insurance. This is a way that you can get health insurance or help pay for your health insurance until you're on Medicare with money that's not taxable. So I could take money out of my Roth, help pay help live on that till I get to that point. And I may be getting some help with my health insurance supplemented by the Affordable Care Act, where I'm not paying a premium. I have one couple that we did retirement planning. They're taking money out of their Roth and their savings account to live on to the year to bridge them over to then be on Medicare. So they're really showing hardly any income. But what happens is then they qualify for the Affordable Care Act, and the insurance that would be costing them in the neighborhood of $1,600 is costing them around $300 a month. So it's about a $1,300 savings in that example with their dynamics of their situation by us using the Roth and some other money they've just set aside in various savings accounts to live on until they bridge that gap. Once we get to Medicare, then we don't care if we generate more income because it's not going to affect the Affordable Care Act because you're no longer on it. So it's a planning tool that we've used in the past. Reduce your tax burden by converting just enough money to stay under the tax bracket. Now, one of the things that we are going to talk about is making sure when you think about a Roth conversion, which we should think about with a lot of people, and when we're doing our planning, and it's one of the areas we're really emphasizing, at least let's take a look at it, is you want to make sure that you understand your tax brackets. because depending on what I convert when I'm looking at my tax brackets, you basically can see, and I'm just going to pull out one of my tax brackets here. So say, for example, in 2022, if you're under $83,550, you're in a 12% tax bracket. From 83 to 178, you're in a 22%. And then it goes up from there. So I want to watch those brackets, and I'll show more of that to make sure that I'm accounting for what I'm going to pay in taxes. So if I take $100,000 on my IRA and convert it to a Roth, I'm going to have to pay taxes on $100,000. What rate would that $100,000 throw me into? Or $10,000 or $5,000 or whatever you convert it. Now spread the conversion over several tax years. I think that's a very important element that you do that if it makes sense. So for example, I don't have to convert if I had a $100,000 IRA. I may want to convert 10,000 this year, 10,000 the next year. I don't have to do it all right away. So it is something that we're looking at it. Again, from a tax planning standpoint, we are not accountants, and I always suggest that people address this with their tax advisor, but we can give you some guidance on what would make the most sense to look at. Doing the conversion a year when your income is unusually low. So if I have a year where I don't have a lot of income, it may make sense. I've dealt with some people that are in sales and different areas where we've converted at certain times, depending on the cash flow that they've had from an income standpoint. Now, I'm going to mention this briefly. It's called a backdoor Roth. Now, one of the things that you have is you do have a situation where some people, as I mentioned, make too much to qualify for an IRA deduction. So what they do is you can do, and they make too much to qualify for a Roth conversion. But there are ways that you can look at that and say, what can I do with a backdoor Roth? Saving strategy where you make a non-deductible IRA contribution, then you can convert that amount. So what happens, it allows you to convert that amount over. I'm not going to get into that in a lot of details, but if you do have a higher income limit, when we start getting into the bigger numbers, we can look at ways that we might be able to do some basic conversion by converting a contribution you made on a non-deductible basis. Now, I talked about income tax brackets, and I just wanted to show those. So these are the tax brackets for when you look at 2022. Again, what I want you to look at, if we'll just pick on married filing jointly here. So these are the brackets that we have: 0 to 20, 20 to 83, 83 to 178, 178 to 340. Keep in mind that this is what you're going to pay on each additional dollar over these limits. Again, we have tax brackets. So the first amount I pay this, the second amount I pay this, third and fourth over that amount. What you don't want to do, or want to at least evaluate if it makes sense to do it, when you convert, is all of a sudden throw yourself up into the higher tax brackets. And I didn't even put everything on here because we can go up further from that. We can go up to a 37% tax bracket if you're earning more than $647,000. So these keep going up from there. So you want to make sure when you're doing your conversion that you don't convert $1 million IRA that's going to throw you into the highest tax bracket. So what we do is we have some planning software where we can use to evaluate, does this make sense for you? Now, one of the areas I just want to mention, just so people are aware of this, depending on your income, you can end up paying taxes on if you're retired and on Medicare. So what happens is you can see if I'm retired and on Medicare, if I'm earning over $91,000, if my adjusted gross income are over these limits, what can happen is I can actually end up paying additional premiums for my Medicare Part B, for my prescription drug. So you could start seeing this number increase if your AGI is too high. So if I up my AGI by doing a large conversion, we just need to take into account if I go over 114,000, I may end up paying a little bit more from that standpoint. If I'm up in this 142 range, you can see, and also on prescription drug, I could end up being paid more. Again, not a huge worry from just the overall planning, but it's something I do want people to be aware of. By upping your income when you do the conversion, it could change your Medicare premiums. It's just something to be aware of. And if you're doing this for each spouse, it can actually, take that up to $550 approximately that you'd be paying instead of the one, an additional premium, plus 272. So it's the 170 is the base premium, plus you'd pay some additional premium. Now, I do want to give an example here of what I think makes sense from a standpoint of converting when holdings are down. First of all, when we do a conversion, we can pick particular assets and say we want to convert those assets. So if I have I'm using an example here of Microsoft stock. If I had that in my IRA, I could say I want to convert some of those shares, all those shares, whatever I want to do. When stocks are down, many times it is a good time to convert. When accounts are down, many times it's a good time to convert. If I think Microsoft is going to be a great stock, and if I look at the start of the year, it was $335 price, and I did this on 6/29, you can see it was at $260. It was down 24.5%. So let's say I wanted to convert $10,000 of that. So I said, okay, I want to convert so many shares around $10,000. So I do that. I'm converting it when these shares are down. Let's say Microsoft, I convert the shares, I pay taxes from another source. So if I'm in a lower tax bracket, say I pay 12%, that'd be $1,200. I assume the stock goes back up by 25%. So now my stock is now worth $12,500. Now remember, I did pay $1,200 in taxes. So I minus out the taxes that I paid from another source. I'm actually up now to $11,300. Now the big difference here is my $10,000 is now worth $11,300. But what I've done is I've locked in now an asset that I'm never going to pay taxes on as it grows. So if this stock grows to $500 a share, I basically, whatever gain I have on it, it's in the Roth now. So it is going to be tax-free money. This is a relatively, I mentioned, simplistic example. There's a lot of different variables that we have to take into account, and you should always consult your tax advisor, but we do feel it's a great product to look at when assets are down. A brief overview, I want to keep this relatively short when we're talking about Roth conversions because it is very individualized. When we're sitting down with clients and going through the Roth conversion, it's something that we look at your particular situation. This is not a concept that's across the board that we say everybody should do a Roth conversion, but it is something that we should think about. Does it make sense in your situation to try to get some dollars in a tax-free standpoint? I'm going to look at some questions that I have. Let me just pull up. Some people have submitted a couple questions. Okay, a couple, let me read these here. First question is, are Roths something that's very particular to my situation, which is just where I came off of? Yes. I mean, it does make sense to look at it from your standpoint and depending on what tax bracket you're in. So that's one where we look at it. Another question, is there a difference in which stocks that I convert? Well, I mean, I would convert stocks that you think have the highest opportunity of going up dramatically, because then you've just taken stocks or whatever you do convert. So when we're looking at conversions and we're looking at particular holdings, we try to pick the ones that we think have the best opportunity with the most growth that they're going to have in the future. So again, if I'm looking at a stock that I've been in and out of just personally myself over the years is Exact Science, which is a company out of Madison that makes Cologuard, the colon cancer detection. That stock goes all over the board. It happens to be down quite a bit now. I looked at converting some of that stock and did convert some of that into my Roth. What that does is, again, it's a very volatile stock. Maybe it won't go up again, and it traditionally has, but let's say it does. I've got a stock that I think can maybe double back again. And now I've paid the taxes on that amount and I'll have a good opportunity to see that grow over a period of time. So yes, it does make a difference which holdings that you look at converting. Again, you're going to pay taxes on whatever you convert. If I convert $1,000 of X or $1,000 of Y, I'm going to pay taxes on that amount. It doesn't matter. But you're trying to get assets that are going to grow in your Roth. When we're doing planning, for example, and you have a Roth and a regular IRA, we will put more of the what I call growth assets, aggressive assets in the Roth. because what happens is we want that growth in there because you're putting more in tax-free. If I have a regular IRA, maybe I put things that aren't going to be more value, more bonds that might not grow as quickly. So I try to use the Roth as a vehicle for assets that are going to grow on an ongoing basis. Another question is, do you ever see Roths being taxed? Currently, no. Ever is a long time, and I always try to be cautious on that. I mean, there's been tax law changes I've seen over my 40 years in this business that have surprised me. Social Security became taxable in the 80s. There's a lot of things that have changed. I mean, I have seen some bantering over the years way in the back room on this about, you know, if you had over so much in a Roth, would it make sense to say you may have to pay some sort of surcharge on that? That's gotten shot down very quickly and never really went anywhere. I mean, the Roth is a vehicle that you already have paid taxes on. So the government, one of the concepts here is we went away from pensions and we went away from employee-sponsored retirement plans where the employer is putting the money in for you. The government does like people to set aside money for their own retirement to hopefully take some pressure off of Social Security and just the overall burden that we'd see if people didn't have money set aside for retirement. So no, I don't see this right now. There's no talk about it, and I don't see it in the future. And we do hope and have seen in the past many times things may be grandfathered if you're already in it. Don't know if that would happen, but it is something that we would see. That's most of our questions. I know we're currently at the pushing the 30 minutes here. I do want to thank everyone for their time. If you have any questions overall, feel free to give us a call. That's what we're here for. I'm going to do these on a more ongoing basis on certain ideas that do make sense. And right now is a time where I think we do need to talk about Roth conversions if it does make sense. Thank you for your time and have a great day.